Saving for the future. Introduction. Imagine waking up one morning and realizing that you have enough money saved to cover your rent, buy food, and pay your bills for several months even if you lost your job today. Imagine being able to say yes to opportunities like starting a small business, pursuing further education, or traveling abroad without worrying about how to pay for it. This is the power of saving. For many young people aged 18 to 35, money is often seen as something that comes in and goes out quickly. With daily expenses, school fees, family responsibilities, and the desire to enjoy life, saving can feel like an impossible dream. But in reality, saving is not about how much you earn, it's about how you manage what you have. This module will help you understand why saving is important both in the short term and long term. Types of savings accounts, the tools you can use to protect and grow your money. How to build the habit of saving, turning saving into a lifestyle, not just an occasional event. By the end of this lesson, you will not only understand the principles of saving but also be ready to teach them to others as part of the financial literacy movement in schools through coffee clubs. Section 1. Why saving is important. 1.1 Saving builds security. Life is unpredictable. Jobs can be lost, businesses can fail, health emergencies can happen. Without savings, even small financial shocks can throw someone into crisis. For example, a medical bill of $100 may not seem large, but if you have zero savings, it becomes a major problem. A broken phone, lost job, or urgent school fee could push someone into debt or borrowing at high interest. Savings act as a safety net, giving you peace of mind that no matter what happens, you are prepared. 1.2 Saving builds opportunities. Beyond emergencies, savings create opportunities. For young people, this could mean paying for higher education or professional training, starting a business, contributing to family needs or community projects, traveling or pursuing global opportunities. Without savings, these opportunities may pass by because you simply don't have the money when needed. Financial independence. Many young people depend heavily on parents, relatives, or loans. While support can be helpful, true independence comes when you can make decisions with your own money. Saving empowers you to say yes or no without waiting for someone else's help. 1.4 Saving builds wealth. Wealth does not start with big businesses or high-paying jobs, it starts with small, consistent savings. Over time, savings can be invested to grow, leading to financial freedom. For example, saving just $1 a day adds up to $365 in a year. With compound interest, those small amounts can grow significantly over time. Key teaching point for schools. Teach students that even saving coins or small amounts daily makes a big difference. Little drops of water make a mighty ocean. Section 2. Types of savings accounts. Not all savings methods are equal. Understanding the different types helps young people choose the right place to keep their money safe and growing. 2.1 Traditional savings, home savings. This is when people keep money at home in a box, under the mattress, or hidden in the house. Pros: easy to access anytime. Cons: unsafe, theft, fire, spending temptation, does not grow. Best only for very small amounts or daily petty cash. Bank savings accounts. Banks remain the most reliable institutions for saving. Pros: safe, earns small interest, provides financial history, access to financial services, loans, investments. Cons: may require ID or documents to open, some accounts have fees. Encourage young people to research youth-friendly or student accounts with zero minimum balance and low fees. 2. 3 Credit unions and cooperative savings. Community-based savings groups or cooperatives where members pool money. Pros: easy to join, encourages discipline, members can borrow at low interest. Cons: limited access outside the community, risk if management is poor. 2.4 Digital savings, fintech and mobile money. In many parts of the world, especially Africa and Asia, mobile money and digital savings apps are revolutionizing finance. Examples: M-Pesa, Kenya, Opay, Nigeria, Chime, USA, Paytm, India. Pros: accessible via phone, user-friendly, encourages micro-savings, e.g., saving 50 cents at a time. Cons: dependence on technology, possible transaction fees. This method is particularly attractive to young people who are already comfortable with smartphones and apps. 2.5 Fixed deposit and investment accounts. For those who want to save money for a longer period, banks offer fixed deposit accounts where money is locked for a set time. Pros: higher interest than regular savings. Cons: cannot withdraw before maturity without penalty. This is great for long-term goals like paying for university, buying land, or starting a business. Section 3. Building the habit of saving. Knowing why and where to save is not enough. The real challenge is developing discipline. Here's how young people can build the habit. 3.1 Start small. Don't wait until you have a lot of money. Begin with what you have. Save $1 a day. Save 10% of any money you receive, pocket money, salary, business profits, gifts. Even small amounts grow with consistency. 3.2 Pay yourself first. Treat saving like an expense. As soon as you receive money, set aside your savings before spending on anything else. For example, if you earn $100, save $10 immediately. Only spend the remaining $90. 3.3 Automate savings. Use bank standing orders or digital apps that automatically move money from your income to your savings account. This removes temptation. 3.4 Have clear goals. People save better when they have goals. Examples. Short-term goal: save $300 for a laptop within 6 months. Long-term goal: save $5,000 for graduate school in 3 years. Visualize your goal, write it down, make a savings chart, or use a savings app. 3.5 Create an emergency fund. One of the first goals of saving should be to build an emergency fund. Aim for 3 to 6 months worth of basic living expenses. This prevents borrowing when unexpected events occur. 3.6 Avoid lifestyle inflation. As income grows, people often spend more: new clothes, new phone, eating out. Instead, increase savings whenever income rises. For example, if you get a $50 raise, save at least $25 of it. 3.7 Reward yourself. Saving should not feel like punishment. Occasionally reward yourself with something small after achieving a goal. This builds motivation to continue. Practical exercises for young leaders. Personal Savings Challenge. Save a fixed amount daily, e.g., $1 per day, for 30 days. At the end, calculate the total. Savings jar exercise, for schools. Students create labeled jars: education fund, emergency fund, dream goal. Each week, they put a coin or note into each jar. Digital savings trial. Encourage participants to download a digital wallet app and save a small daily amount for a month. Teach needs versus wants. Create a list of 10 items: rent, shoes, snacks, Netflix subscription, tuition, etc. Students categorize into needs or wants. Discuss how cutting some wants can increase savings. School application, teaching students. As future financial literacy leaders, here's how you can teach savings to schoolchildren. Storytelling. Use simple stories like a farmer who saved seeds for the next season to show why saving matters. Games. Create a savings competition where students save coins weekly, and the winner is the one with the most disciplined record. Practical projects. Help students open simple savings accounts or join school savings clubs. Conclusion. Saving is not just about money, it's about preparing for life, creating opportunities, and building independence. For young people aged 18 to 35, mastering savings early is the foundation for financial success. Key takeaways. Why save? To build security, opportunities, independence, and wealth. Where to save? Options include home savings, banks, cooperatives, digital wallets, and fixed deposits. How to save? Start small, pay yourself first, automate, set goals, and avoid lifestyle inflation. When you master saving, you are not only securing your own future but also becoming a role model for students and communities. By teaching others through coffee clubs, you multiply the impact, raising a financially empowered generation.